Well, hi, JD here again with another finance related video for you. This one is going to look at the different kind of interest terms when you take out a finance product, a car or whatever it might be. And I think this is useful because in previous years gone by, I have been into car dealers and I've said to them, okay, well, what's the interest rate on this finance agreement? And to be fair, I don't think this happens as much as it used to, but certainly in the past they would say something like, oh, we've got a great deal this month, we can do you this deal at 3.5%. And you know, me not knowing any different in previous years would have gone, oh yeah, that sounds good, 3.5%. Well, I know I could, providing I could get the best rate possible, I know I might be able to get 3.2 at Sainsbury's or Tesco or somewhere like that. So actually 3.5%, given the fact that it's, you know, it's a regulated agreement and we've got protection and, you know, we can voluntarily terminate and all sorts of things, that's actually a really good rate. Okay, brilliant. Where do I sign? So you sign it and then you go on the day to pick your car up and you get the proper agreement through and it says 7.5% APR. And you go, oh, hang on a minute, I thought it was 3.5. How come it's 7.5? Bit late then, you've signed for it. Anyway, so what I want to do with this video is kind of clear up what the different terms mean. Okay, essentially, if you ever ask your dealer or the business manager or whatever it is, what is the interest rate, I would like to think now that they will quote certainly in annual rates or annual equivalent rates or APR and not flat. There's this term called flat rate, and that is kind of what happened with that previous example that I just mentioned. You ask a dealer for an interest rate and they say 3.5%. Always say, is that flat? And if they say, yes, it's flat, you've just got to think, well, okay, it's not so good. And I'll show you why with this example, that a good rule of thumb is to always double the quoted flat rate to give you an indication of what the true annual rate's going to be. And then we'll look at the different kind of annual rates. So looking at the screen here, very, very simple example. If I were to borrow £100 on the 1st of January and I was going to pay it back on the 31st of December in one instalment, and they said to me the interest rate is 10% flat, it's a really easy way to kind of demonstrate what's going on. So 10% of £100 is £10. That's not particularly difficult. So the total amount we're going to give them back on the 31st of December is £110. Well, that makes sense because 100 plus 10% interest is £110. So the amount I'm being charged in interest is £10, and therefore the interest rate is 10%. And that makes sense. But that really is the only place that flat rate makes sense. Another way to look at it is if you invest some money in a savings account and you look at the interest rates and they're paying 2%. And if they pay annually, so once a year, again, it makes sense. So I'll put £100 in on day one, and on day 365 they give me £2 in interest, 2%. So I've got £102. Brilliant. Starts to get a little bit more complicated though when I keep that money in for the next year, because now I've got £102 on January the 1st and they're going to give me 2% again. So they're not going to give me another £2, they're going to give me a little bit more because I've got interest on the £2 as well. And that's why we can't really use flat rate when we're buying cars, because we usually pay monthly. And what you've got to remember is, unlike investing money, each month goes by, as you've seen from my previous spreadsheet video, we owe a little bit less. So it would kind of suggest that the interest that we owe should come down a little bit as well. And it did when I showed you the previous spreadsheet. As each month went by, we paid the same fixed amount, but the capital section was going up, the interest payable was going down. Now, let me explain with this flat rate example. Let's assume that we're paying it monthly, we're not paying it annually. A very easy way, and I think I'm right in explaining it this way, is imagine that you borrow your £100 on January the 1st and you're paying it down in equal instalments. On December the 31st or thereabouts, you're going to owe zero. So you've got like a falling linear line. So £100 at the beginning, £0 at the end. So what are we going to owe roughly after 6 months? We're going to owe £50, £100 here, 0 here, £50 in the middle. So what I've got here, look, is an example. We've got £100. The total amount payable we've decided is £110. We divide that by 12. So up here, look, so all I've done is 110 divided by 12. That gives me a monthly instalment of £9.17. I've rounded that up a little bit, £9.17, okay? So how much have we paid after 6 payments? Well, we've paid £55. 6 times £9.17 is, near as damn it, £55. So essentially, halfway through the term, we don't owe £100 anymore, we don't owe 0, we owe £55. But they've told us that the amount of interest that we're going to be paying is £10. So effectively, the interest rate is now £10, which is the amount we've been told we're going to pay. Forget about percentages, think about the actual amount we're going to pay, £10, and the amount outstanding, or the average amount owing halfway through the term, is £55. So if we now work out if we work out £10 divided by £55, we actually get 18.2%. Okay, 18.18%. So you can see that our interest rate has almost doubled because we're paying some of that capital down. So straight away, we've gone from 10% to nearly, well, to just over 18%. So that's kind of why flat rate doesn't work. Now, what that figure is there is still an annual rate. What we need to do is we need to take that and work out what our annual equivalent rate is. So I'm going to give you another example here. I'll skip this one because it makes more sense with this one. In a previous video, one of my viewers kindly sent me an example of their finance agreement when they took out gap cover. And the interesting thing about this is even though it's quite a high rate, it's got a lot of information on it. And you can see that they are quoting him 9.01% per annum. So that's our annual rate. But it's also got this thing here that says APR 9.4%. Now, the difference between annual rate and APR is the fact that APR has a compounding effect in it because we are paying interest monthly, and I'll explain how we work that out in a second. But secondly, APR also includes charges. So APR is the only fair way to compare different finance agreements. You could have exactly the same interest rate and you could have a totally different APR. And that's because, let's say I have an annual rate of 5% and another lender has an annual rate of 5%, but I charge you no admin fee to set the loan up and I charge you no option to purchase fee at the end. My annual rate is 5%, and as you'll see in a minute, it's quite easy to convert that to what we call an annual equivalent rate. However, if somebody else has an annual rate of 5% but charges £250 admin fee at the start and £250 option to purchase fee at the end, even though it's not interest, it's still a charge. So you're still paying back more than you've borrowed. So whether it's interest or whether it's a charge, you're still having to pay it back. And that's where APR comes in, because APR includes all charges as well. Now, my previous spreadsheet, I talked about ignoring those now, because certainly with the finance agreements I've used in the past, the option to purchase fee is so small, it's £1, it's negligible, so I don't kind of concern myself with it. So, in this case, APR is the same as AER, annual equivalent rate, because there are no additional charges. Yeah, we borrow £399 to pay our gap cover, we charge £76.17 in interest, and that's the total amount payable. If it were to say total charge for credit £76.17 plus an acceptance fee of £10, then even though the interest rate per annum is 9.01, the APR would be higher. So I want to prove how you can convert 9.01 annual rate to 9.4% AER or APR. And all you have to do, is quite simple, is I've got this example here, look. So I've put my annual rate in of 9.01%. How do we convert that to an annual equivalent rate? Well, what we have to do is we have to work out our monthly interest rate, and then rather than multiplying it back by 12 monthly payments, you have to raise it to the power of 12, because that takes into account compounding. So interest in month 1, on month 2, interest on my interest, on month 3, interest on my interest on my interest. So you can't simply take your monthly interest rate and multiply it by 12. All that will give you is your effective annual rate, assuming that nothing was being paid down and assuming that we weren't making monthly instalments. That works if you do it that way. Like with my previous example, a rate of 10%, it goes to show that our monthly rate is going to be 10 divided by 12, because we're not paying anything down and we're just paying it back at the end. But because we are paying this down monthly, we have to compound it. So all I've done here is I've taken my 9.01%, I've divided it by 12 to effectively get 0.75% per month. And then what we have to do is just raise that, excuse me, we have to raise that to the power of 12 to get the what we call the annual equivalent rate. And that comes out at, I'll show you the formula if anybody's interested. So all I've done here, look, is I've taken 9.01 and divided it by 12. So 9.01 was in cell P3, divided that by 12. I've just multiplied it by 100 here, just to make it look more easy to understand, 0.75%, even though they are exactly the same numbers. And then to get my AER rate, what you have to do is you have to take your monthly rate, which in this case was 0.75%, you have to add 1 onto it. And the reason you add 1 onto it is obviously anything that's got a 0 to the left of the decimal place, every time you multiply a number that starts 0 or you increase it to the power of something, it's going to get smaller and smaller and smaller and smaller. So you have to add that 1 on so that it has the compounding effect of getting larger. So I've taken 0.75%, I've added 1 onto it, and then I've just raised it to the power of 12 to give me those 12 compounding effects. And as you can see, the answer comes out at 1.09391547. So rounded up gives us 9.4%, which is exactly what the agreement said just here. So if you've ever wondered, well, why is it 9.01 per annum, but it's 9.4% APR or AER, that's why, okay? I'm trying to think if there's anything else I need to mention at this stage. Oh yes, one interesting point, look. You see the AER, look, is 9.391547, and if you look at my previous video, I'll put a link to it up here. That's why I was talking about if you enter the APR figure into my spreadsheet of say 3.9, it's going to give you a slightly different answer, because that 3.9% has been rounded to 1 decimal place, and it could be based on an annual equivalent rate of something like as in this case, look, 1.09391547. Oh, one other point. The interesting thing is, the smaller the annual rate, the smaller the difference there will be between annual rate and annual equivalent rate. If you look here, look, with an annual rate of 9.01, there's quite a significant difference, quite a significant jump between 9.01 and almost 9.5%, because it's compounded, so that difference is going to get bigger. If I go to my previous spreadsheet example, if you look here, my APR on the BMW M140 that I bought was 3.9, but you see the annual rate is, imagine this was multiplied by 100, 3.832. So the difference between 3.832% and 3.9% is quite small. And that's because, as I said, the smaller the annual rate, the smaller the jump will be to take you to the APR or the AER. So just remember, this effectively is the same as AER, because I haven't got any charges on it. I might change the spreadsheet one day to actually add some effective charges as well, because that will make the APR get even larger. I hope that was useful. I apologise if it's a little bit complicated, but I just wanted to explain the difference between these different rates. So all I would say, when you're buying your car, make sure you would certainly see the annual rate and ideally the APR or the AER on your agreement. Make sure you ask the dealer, is this rate you're quoting me flat rate or annual rate? Please comment and subscribe below. See you next time. Thanks for watching.